In his 2014 annual letter to shareholders, Warren Buffett said this about the importance of cash. Cash is to a business as oxygen is to an individual. That's the importance of cash in a business. So we decided to check which Indian companies excel as far as cash is concerned. Hello and welcome to ET Money's YouTube channel. Today, we will delve into cash as an analytical metric and pick Indian stocks that do well on cash-related criteria. We will be checking three cash-related metrics: cash on the books, cash flow from operations, and free cash flows. Now for each of the metrics, we will give you lists of companies that stand out. So if you are interested in picking fundamentally solid hidden gems, do watch this video till the end. But before I start, an important update. We recently launched the stock discovery feature on the ET Money app. With just one tap, you can now get every detail about a stock and its underlying business, plus a lot more. So do check it out. Okay, so let's begin with the most straightforward cash metric: cash on the balance sheet. On your screen is the asset section of Infosys balance sheet as of 2023 and 2024. This section has two parts: non-current assets and current assets. Now, non-current assets are those that can't be readily converted into cash, and the opposite is true for current assets. Now, cash belongs to the current assets section. As of March 2024, it stands at 14,786 crore for Infosys. That's up from 12,173 crore at the end of March 2023. Now, this cash on the balance sheet is quite important. It helps meet urgent and immediate financial requirements, debt obligations, capital investment requirements, etc. It's like the emergency fund in your personal financial plan. So a high value of cash on the balance sheet is usually an indicator of business strength. Now, on your screen are top 25 companies in the BSE 500 group of stocks in terms of their cash and cash equivalents. Reliance Industries tops the list with a cash balance of over 97,000 crores. It's followed by Tata Motors that has about 46,000 crore and ONGC with about 37,000 crores. Next comes Coal India and Hindustan Aeronautics with cash holdings about 30,000 crore and 26,000 crores respectively. Infosys, whose example we just took earlier, is at the 10th position. So these were the top 25 names in the absolute terms. However, do note that we have excluded banks, finance, and insurance companies from this list as they have different business models and regulatory requirements. Throughout this video, we will consider only non-BFSI companies. Now, to put the cash amount in perspective, it can be compared with a company's market cap. And when we do so, the list changes dramatically. On your screen are the top 25 companies in terms of cash holdings as a percentage of market cap. The top name in the list is Nuvama Wealth Management, whose cash balance is over 50% of its market cap. Then comes ICICI Securities at 41%, followed by Angel One at 34%, GFSC and Rajesh Exports at 27%. So, these were our cash kings in terms of absolute cash on the balance sheet and cash on the balance sheet as a percentage of market cap. Okay, let's now move to the next cash related metric. Cash flows from operations, or the CFO, is the cash generated by a business from its core business operation. It's also called operating cash flow, or OCF. Now, CFO or OCF is the part of company's cash flow statement. Now, this number should always be checked alongside the profit figure to ensure that the profits are indeed converting into cash. Now, accrual accounting allows revenues and profits to be booked before the actual realization happens, so they can be manipulated. And this can create a wide gap between net profit and CFO. Now, normally the CFO should be higher than net profit, as while calculating the CFO, depreciation is added back. CFO can be much larger than net profit if the company has incurred a large amount of non-cash charge such as depreciation. That can happen in asset-heavy businesses like utilities. So, as our next set of cash kings, let's filter out companies whose CFO is significantly higher than their reported net profits. On your screens are the top 25 names in terms of their CFO to net profit ratio. The top names in this list are Piramal Pharma, whose CFO to PAT ratio is 56 times, Jubilant Pharmnova and Shobha at 13 times, Nuvoco Vistas at 11 times, and Bharti Airtel at 9 times. Now, there is yet another important application of the CFO as a valuation tool. Now, You may be aware of the PE ratio as a valuation tool. It's derived by dividing the stock price by earnings per share or EPS. Now the PE ratio uses the EPS in its calculation, which in turn is derived from the net profit. And as we saw, the net profit can be manipulated. So a more rigorous valuation measure can be price to cash flow ratio. This ratio is also called the market cap to CFO ratio. Lower this number, the cheaper a stock is. Now on your screen are the top 25 non-BFSI names in the BSE 500 with the low P to CF ratio. The top names in terms of P to CF are BPCL, HPCL, Vedanta, Indian Oil and ONGC. Their P to CF ratios range from 1.8 to 3.4. Now you can also compare the PE ratio with the P to CF ratio to see the difference in two valuation metrics. For instance, consider Nuvoco Vistas, a cement company. Its PE appears to be ultra high at 95 times, but its P to CF is much lower at 7. Vedanta's P to CF is about 3, but its PE is 37. Birla Corporation, another cement company, has a P to CF of 7 as against a PE of 25. Now, as the beauty lies in the eyes of the beholder, valuation lies in the eyes of the investor. So do feel free to use the valuation metric that you find most appropriate. But do remember that P to CF can be a better valuation metric for companies that show low profits or even a loss due to non-cash charges like depreciation. Okay, now let's talk about the third and the final cash metric. Free cash flow or FCF is an analytical metric that tells us how much cash a business is left with after accounting for operating expenses such as rent, marketing, payroll, R&D, etc. and capital expenditure. The excess cash left can be used to pay dividends or interest or repay creditors or to expand the business or any other business activity. So FCF is a good indicator of business and financial strength. It is calculated by subtracting capital expenditure from cash flow from operations. Now on your screen are the top 25 ex-BFSI names in terms of absolute free cash flows. Indian Oil, ONGC, BPCL, TCS and Tata Motors top this list, with free cash flow ranging from over 30,000 crores to about 62,000 crores. Now just like P to CF, P to FCF can also be a valuation metric. With lower the number, the better. This is an even rigorous metric than P to CF, as while calculating the FCF, capital expenditure is deducted from the CFO. On your screen are the top 25 companies in BSE 500 with the list P to FCF ratio. The toppers of the list are BPCL, Indian Oil, HPCL, Great Eastern Shipping and Chambal Fertilizers with P to FCF values of 2.8, 3.8, 5.1, 5.7 and 5.8. Now for reference, you can also compare the P to CF with the PE ratios of the stocks. So these were some popular cash related metrics and the companies that excel in them. But how should you go about using this information? More importantly, are there any caveats to using cash related metrics? Let's answer these questions in the concluding section of this video. As we discussed at the beginning, cash is an important indicator of business strength, but no metric, including cash-related ones, should be seen in isolation, nor are cash metrics sacrosanct and beyond questioning. So can too much cash be a bad thing as well? A high cash balance on a book can also portend the company is preparing for a major financial crisis. It may signal that the management doesn't know what to do with the cash and just keeps hoarding it, thus incurring opportunity cost for the shareholders. A cash-rich company can also become reckless with its decision as it has a cushion to backfall on. Similarly, a company that has little free cash flows isn't automatically a bad company. Companies that are in the growth phase often have little or no free cash flows. Companies that throw huge cash can also be mature businesses that don't generate much shareholder wealth via stock price appreciation. So don't rush to buy the stocks mentioned in this video. They aren't our recommendations either. They are just there as an example of the metrics we are discussing. Now, how to use this data and more importantly, the cash related criteria then? Well, cash related metrics can be a good starting point for your research. Use them along with other metrics to select fundamentally solid stocks for your portfolio. You can check the How to Pick Stocks playlist on this channel for more stock picking frameworks. I've included its link in the description. And with this, we have come to the end of the video. I hope you found this video useful. And if you did, please don't forget to share it with your friends and family. I'll be back soon with another video. Till then, take care.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.